Welcome to the Transparent FX Academy. I'm Nick and I'm a top author trading view with over 190k reputation points. In this video, I'll speak about gold. And as usual, to keep the video as educational as possible, first I'll cover the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders, which is what the big players in the market are doing and how they're moving and shifting their orders, which you see right here. And by the end of the video, by using the combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. So this is definitely a video you do not want to miss. So without further ado, let's jump straight into it. Starting here from the monthly time frame, what we can see is that we have a market which at the moment clearly is still in a monthly uptrend. We have seen the creation of monthly higher highs and higher lows. Every single time the market went higher, we had the correction and then immediately the continuation to the upside, printing, if we start from here, 3 higher lows, and already we can notice that we are now at the third higher high. Then the next logical step would be for the market first to provide a correction, create a new higher low, and then potentially continue higher, because until the market will continue creating higher highs, we could reasonably expect the market to also create higher lows, so remain with an intact monthly uptrend. We can see that all this uptrend is coming as a development away from a strong historical structured zone, which was broken to the upside, retested and rejected. In fact, from here, all these previous rejections to the downside were created. The market then broke above that zone with this impulse, went for the retest, and currently it is rejecting the level to the upside. So more bullish price action could be expected away from this level. But the first logical step would be first to see a correction and then the continuation to the upside. So let's keep all of this in mind and drop down on the weekly time frame. From a weekly perspective, the pattern is very clear. We can see a strong impulse to the upside followed by this triangle formation, which is simply put in a consolidation pattern. Now, you can call it triangle formation, you can call it a wedge, but the base concept is very simple. When you have the creation of lower highs and at the same time higher lows, you essentially have a converging market, which usually happens after an impulse, and at some point you have the breakout to the upside and the continuation, which is a pattern that for sure you saw many times, or anyway you read about it in textbooks essentially that speak about technical analysis. This is a very popular pattern. And so far, the market has been behaving exactly as you would expect in this kind of situation. However, as you know, and if you studied this pattern already, so wedge formations, usually the next impulse is of the same length than the previous impulse, which in this case, we can see that we also have that already. The market has already moved by the same length of the previous impulse leg. In fact, if we, for example, measure it from here to here, and we clone this, we can see how already we have gotten pretty much the same move. So it is only normal that the market at this point would become overextended to the upside and would provide another correction. Dropping down on the daily time frame, we can as well notice how the market is quite overextended to the upside. Now, I did speak about gold just a few days ago after this impulse and correction. When the market was around this area, I explained all the reasons for which I was expecting this rejection to the upside, and in fact that is exactly what the market gave us. And by the way, I will link in description that previous analysis so you can go and check it out for more free education. But now that the market has created this move, what kind of situation we have? Well, in creating this move to the upside, the market has also printed this overextended W formation. Now, in general, after the creation of an overextended W, what you would expect is for the market to create a rejection to the downside, precisely for the market to retrace at least to the 0.32 of the Fibonacci taken on the impulse leg, which at the moment is around this zone. So essentially, until the market will retrace at least to the 0.32, the market will be overextended from a daily perspective, and we could expect to see more institutional shorting. Now, speaking about institutional shorting, if we go and see what we have when it comes to the commitment of traders, so what the big players in the market are doing, and we look at the data precisely for gold, we can see how with the last reports, net positions have now once again started to be decreased. We went from 257k net positions down to 249.7k net positions, showing how institutions are once again moving back to the bearish side for gold, adding 3,000 shorts just with the last report and closing 5,000 longs. So institutions are again moving back to the bearish side for gold, therefore making it weaker. So if we move back to the chart, what do we have? And by the way, if you still haven't, make sure that you join my free Telegram channel, which you'll find linked as well in the description, so you never miss new updates. Now back to the analysis. So in a situation like this, we definitely have an overextended market with institutions that have already started adding shorts, thousands of shorts, and closing thousands of longs. So there is a good probability that this could continue, and at that point the market would become really overextended and ready for a correction. So in a situation like this, what would I expect? Well, as my students know very well, trading is reactive and not predictive. The monthly, weekly, and daily time frames combined with the COT data, those are the best time frames when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best time frames for that are the intraday time frames, so 4 hour and lower. Therefore, what I would expect is that if this market would shift from an intraday bullish to a bearish market, I wouldn't be surprised to see a potential rejection to the downside for the market to retrace at least to the 0.32 of the Fibonacci taken on this impulse leg. That definitely wouldn't surprise me. Now, if you want to learn more, I really recommend that you go and check out my website, which is linked in the description, because what you see me share here on YouTube is actually just the tip of the iceberg. In fact, if you head over to the website in the description, you will have the possibility to join the best trading program on the planet. You will gain access to all the courses ranging from the very basics of charting all the way to the more advanced topics like building automated trading strategies using the MQL4 programming language, building portfolios of strategies using quantitative finance tools like the Quant Analyzer, and much more. You will have the possibility, in fact, to gain access to the trading station software with the Telegram notifications integration, one-on-one private mentoring directly with me, the COT data software, which often you see me use directly in my YouTube videos, on all my platforms actually. And if you scroll down, you will see that you also have the possibility to get the integration. So all my EAs, which you find here presented one by one directly on the website. And you also have the possibility to gain access to my live trading show. So I live stream of all the trades on my live account as they're opened, closed, trade, and obviously managed. And if you continue to scroll down, you will see that you have the possibility to join just after here the testimonials and gain automatically access with the email and password that you will create during the checkout process. So I really suggest that at least you go and check it out. The link is in the description and I will see you in it. If you enjoyed the video, make sure to click on the like button. Also, let me know in the comments below any new pairs that you would like me to cover in my next videos. Also, any questions you have, leave them in the comments below. Subscribe to the channel so you never miss new updates, and I will see you in my next video.